Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at another requested stock. And this stock is PayPal Holdings, ticker PYPL. I have a list of about a dozen stocks that you guys have requested that I take a look at. I'm working through them. It takes some research to figure out what's going on with them. So I might have to pick up the number of videos that I'm putting out. We'll see. And I do want to ask that if this is something that you're interested in, that you subscribe to the channel to stay up to date with everything and request stocks because I love to dig into them and look at them. But today we're looking at PayPal. And this stock, my first impressions are definitely leaning towards a buy, but we'll dig in and take a look. It split off from eBay back in 2015, and at $30 a share, it ran all the way up to 310 in 2021, and it has been on a steep decline since then. From 730 2021 all the way to 311 2022, this stock was cut down to 30% of what it once was. And it's kind of slowly continued on that decline. But when we look at the fundamentals of the company, we see a bit of a different story. Yes, 2022 was not a good year for the company, and there's some competition out there. There's Apple Pay, which I think is one of the biggest threats that investors see to PayPal. And there are other things like Cash App, PayPal owns Venmo, and the adoption of cryptocurrencies kind of pose somewhat of a risk unless PayPal finds a good way to integrate them and become the main uh, payment option for those. But we'll see that they potentially could. When we look at the numbers, though, we see as of this year's expectations, it'd be overvalued at $143, so nothing to worry about there. It's currently trading for $62.79. The fair value would be right around 126, which surprisingly is exactly what analysts are looking at too. So when there's more people looking at the stock, I feel like it gets better numbers. There's a wider degree, and if you just take the median, you tend to get a pretty good picture. And spot on 126 is what the average analyst comes up with. And when I run my numbers, I come up with 126.41. So that does confirm that it is undervalued to me. So we'd be looking at a good margin of safety. Good place to buy would be under 110, especially under 100. So I am definitely looking at picking up the stock at today's prices. But let's get into those numbers and see what's going on. We can start with the trends to see what all is going on here. So for financials, we see a great trend in the revenue, and we see a similar trend in the cost of goods as one would expect. Nothing crazy here. Looks good to me. If we dig into the actual numbers, that is 15.69% growth year over year, which is exactly what we like to see. The gross profit, net profit, and EBIT tell a little bit of a different story. We see the gross profit kind of leveled out in 2021, declined a little bit in 2022. It did look like they had some higher expenses, lower margins in 2022. And that could help give us a reason for the declines. Let's see. Yeah, they came up with 8.8% margin in 2022 compared to the 16% in 2021 and 19.6 in 2020. So they had a great year in 2020. But the EBIT rose up in 2020 and has kind of been on the decline since then. Not a great thing. I mean, unless they're investing the money into the business in ways that'll grow future revenues. And then the net profit shows a pretty similar story. But we'd be hoping that they can get back on trend and it would look more like this in 2023 and 2024 for that net profit. So we see their net profit has been shrinking by about 0.5% year over year. that is one point of concern. We can look at their expenses as a portion of revenues and see if that's the reason. 84.3, 84, 83, 85.3. So that just had a high year in 2022. It isn't necessarily trending up. In fact, it was trending down. So we could definitely dig in and see what is going on into these expenses. Why are they spending more money, coming out with a lower margin, raising their expenses as a portion of revenue? And is that going to benefit the company in the future? And then we have the balance sheet. So we see a awesome trend in the assets. Tangible assets look like they're kind of on the decline, mostly flat. Liabilities, not a great trend. It's trending upwards, and the tangible book value is trending pretty flat as well. So if we look at the actual metrics, we see assets have been growing at 15.32%, while the liabilities have been growing at 19.32%. So those liabilities are outpacing the assets. Tangible assets have been shrinking, and therefore tangible book value has been shrinking. But it is positive. We do see a little bit of year-over-year shrinking here, which is a trend that we'd want to see change. Debt to equity. This is a fintech company, so the balance sheet is very different. And I actually have the annual report here so that we can see what's going into these assets, what's going into the liabilities. And we see that one of the largest items here, 36.35 million in 2020, so that'd be billion, are funds receivable and customer accounts. And then the largest liability that they have are funds payable due to customers, which they do owe more to customers than they have collected from customers. But if you take those numbers out, this balance sheet looks very different. And then we'd be looking at the largest asset here would be goodwill, and the largest liability would be their long-term debt. And while we're on this page, we can see the expenses here. So, revenues have been on a great run. Expenses have been gaining pretty quick too. So, where is that mostly coming from? We see a lot of growth in this transaction expense, 7.9, 10.3, 12.2. That's growing very quickly, but that likely means that they are experiencing more transactions and hopefully they're profiting off those. Transaction credit losses, pretty flat, down year in 2021. 2022 was less than 2020. We see some growth, pretty slow in the transaction or in the customer support and operations. Small growth there. Sales and marketing, we see 21 was a high year, down a bit in 2022, but it is higher than 2020's number. General and administrative, they have been holding pretty flat. Restructuring and other charges. So that's where there's a big gain over the previous years there. For 2020, where some restructuring charges. So operating income, they had a higher year in 2022 than in 2020, but 2021 was exceptional. And then other income, they had a pretty high year of loss there. Very good year in 2020 of a gain. Income before taxes just ended up being a lower year. So income before income tax, their lowest year was in 2022. I mean, that was due to the lower operating income and the higher loss here because they had a lower operating income in 2020, but they actually made some income elsewhere. So it all just works out to accounting here to make it that their worst year was in 2022. And earnings per share, it looks like there's a decline here, 358, 355, 210. But the expectations for this year are $4.95, and then in 2024, $5.65. And that is the consensus amongst 43 analysts. So I feel pretty comfortable going with that. We'll follow their earnings to see how they are on track with all of that. So I am not too worried about those 2022 numbers. It looks like it mostly just comes down to restructuring costs and the higher transaction expense. And here they talk about those transaction expenses. The expenses increased by $1.9 billion or 18% in 2022 compared to 2021 due to an increase of TPV of 9% and an uh, unfavorable changes in product mix. The increase in transaction expense rate in 2022 compared to 2021 was also attributable to unfavorable changes in product mix and a higher proportion of TPV from unbranded card processing volume, which generally has higher expense rates and other products and services than other products and services. For the years end December 31st, 2022, 2021, and 2020, approximately 35, 39, and 40% of TPV, respectively, was generated outside of the US. And then there's a revenue breakdown here where we see that transaction revenues have been on a nice rise. Let's see, 25.2 in 2023 or 2022 and 23.4 in 2021. And then if we go down, we see that the transaction expenses were up from 10.3 to 12.2. And so some quick math, we do see a bit of a decline there. They were talking about the unfavorable mix, increased TPV, and we see that 44% of their transaction revenues, there was a 4% increase in the expenses of these transactions. It was 44% expenses in 2021, and in 2022, it was 48.3. So that is something to be aware of. It's not a massive deal to me personally. I mean, they still have over 50% gross margins on those. So I'm not too worried about that, but it is something to be aware of once they start getting, if that continues to drop, that could be a cause for concern. And then I wanted to look into this restructuring as well, because that was the other thing that we saw that was higher. So during the first quarter of 2022, management initiated a strategic reduction of the existing global workforce intended to streamline and optimize our global operations and enhance operating efficiency. This effort focused on reducing redundant operations and simplifying our organizational structure. The associated restructuring charges during the year ended December 31st, 2022 were $121 million. Excuse me. We primarily incurred employee severance and benefits costs, as well as associated consulting costs. The strategic actions associated with the plan were sustainably completed by the fourth quarter of 2022, and the estimated reduction in annualized employee related costs associated with the impact workforce was approximately $265 million, including approximately $100 million in stock based comp. A proportion of the reduction in annual costs associated with the impacted workforce was reinvested into the business to drive additional growth. So I like the sound of that. Yeah, they had higher costs due to this restructuring, but in the long run, it brings down their costs. So that's a decent expense. So that makes me feel even better about this company, where we'd expect to see these expenses going in a better direction if they're focused on restructuring and minimizing to take out redundancies, streamline processes. Their cash on hand has been growing. It was pretty flat from 2020 to 2021, but it is at a high for our time frame right here, where they do have $16.60 on hand per share, which is pretty good considering that the share price is 63.70. They don't pay a dividend. That's my one qualm with the company. I do like holding stocks that pay dividends. They do have good cash flows, holding right around that 20% mark. Last year was again a little low, but they did have some expenses that they had to take care of. And we'd hope this year they'd be back up into the 20s. ROE, again, this is one where like the debt looks to be pretty high because they are a financial company. They do hover right around that 20% mark. And they in 2020 we're at 21. Their worst year here was in 2022. But aside from that, 2019, 14.6, 2021, 19.2. If they can come in on track with everything, they'd be back above 20. And that is something that we do like to see. PE, I mean, they're currently at a 12.87 PE. That is very low. If you look at historically, this company has been 50s and 60s, just shy of 52, 65.4, 53.1, 33.9, 12.8 for 15.69% top line revenue growth. Someone should be willing to pay at least 15 PE for the stock, and that's just another sign that it's definitely undervalued at today's prices. And so this is what we come down to. At the end of 2022, they were looking at their most value coming off earnings, $107 in value off earnings. Most of their value was coming off earnings again in 2023. Most is coming on earnings 2024. It looks like across the board earnings has been the lead driver for value here. So that bottom line seems to be very important to the market, and it has the greatest weighting because of that. But we were looking at a fair value right around 126.41, which means you'd have a pretty good margin of safety to be buying in 107 and below, and you'd want to reevaluate around 140. Now, if it hits that point, we go to the next year's values and we see that the fair value hops up to 227. That margin of safety hops up to 193, and the reevaluation 250. And these are numbers that we've seen before. Back in 2021, it had a fair value of 172, a margin of safety of 224, and a reevaluation at 291. So the huge decline in the stock looks to be coming from that drop from 2021 to 2022 in earnings. $3.55 dropped down to 210, and the stock took a huge dive, dropping 60% when we only saw a 30% decline in the earnings. Back in 2019, they came in at 209, and at that point, they had a balance sheet that was in worse shape. Their cash flows weren't in as good of shape, and the stock was trading for 108. So if you expect them to experience growth, to come in with higher earnings, and you don't think that there's a huge threat from these other financial companies, they'll actually continue to grow at this pace. They'll be a main driver, a main innovator. Then this is definitely a stock to look at. I think that it's a buy for me. I'm probably going to wheel it since they don't pay a dividend, where I'm going to go out probably 2 years out and buy an at the money call. And then I'm going to sell monthly cover calls against that, trying to experience that appreciating share price and creating my own artificial dividend on the stock. But that's what I'm looking at here. Hopefully you enjoyed the video. You learned something. Please like if you did. Comment if there's any other companies that we should take a look at, and subscribe so you can stay up to date on everything else. And I will catch you next time.